where right now a 30-foot tidal wave is hitting us now. We're in it. But what he also said is the tsunami is coming.
Did you know that in the olden days, people used to store their money in coffee cans because they were cautious about placing them in banks? Yes, that was the vulnerability that banks posed ever since the global economic recession. Wondering why the discussion now? Many economists are now forecasting a US economic downturn, and Robert Kiyosaki is once again warning about the US economy, and he believes that the worst case scenario will play out. Today's video is all about the warning and its implications. Numerous economists maintain that surging rates discourage expenditure and consequently could lead to a severe economic downturn. The recent failures of Silicon Valley Bank and Signature Bank have caused many Americans to worry about the economy and the safety of their funds. Although the government has intervened to mitigate the damage caused by the bank failures and ensure that account holders can access their funds, inflation and interest rates still remain high, thereby maintaining the threat of an economic downturn. This situation is referred to as a severe decline in the economy. Conversely, monetary authorities frequently believe that they can attain a purported gentle decline, which implies effectively curbing inflation by raising interest rates without causing a sudden collapse in the economy. In simple terms, Kiyosaki is of the opinion that the economy is on course for a disruptive recession. Here's what occurs to financial institutions during a recession. First of all, it is important to understand the meaning of the term recession. Recessions often come with higher unemployment, reduced consumer spending, and instability or decline in the investment markets. Amidst a recession, the majority of banks' operations are affected. Banks witness a decline in business activity during an economic downturn. In times of recession, the demand for new loans, both from individuals and corporations, decreases. The inevitability leads to reduced earnings for banks. Revenues from stock trading and investment banking also decrease during a recession. We have already begun to observe indications of a significant slowdown in both of these sectors. Financial institutions experience higher loan defaults during an economic downturn. During a recession, numerous individuals and corporations are unable to meet their loan obligations. Consequently, financial institutions face increased loan defaults during an economic downturn. In 2020, US banks had allocated billions of dollars towards reserves for loan defaults. Since the recession resolved quickly, banks released these reserves in 2021, which bolstered their profitability that year. You might have heard of the term bank run. When does a bank experience a bank run? Any idea? Banks may face what is commonly referred to as a bank run, where they are unable to repay depositors in the event of substantial withdrawals. Banks do not keep all the money on hand. Instead, it is lent to borrowers and invested in government bonds. Typically, this situation arises when a large number of depositors are concerned about the bank's stability and withdraw their money simultaneously, making it challenging for the bank to repay them in the short term. Bank runs can be frightening, but they don't always indicate economic instability. According to the Federal Deposit Insurance Corporation, FDIC, which provides insurance for depositors in the event of a bank failure, there are typically a few bank failures each year. In 2021 and 2022, none of the nearly 4,800 institutions insured by the FDIC failed. However, in March 2023, there was a run on Silicon Valley Bank, resulting in the second largest bank failure in US history. Banks may encounter difficulties during a severe economic downturn. So, what are they? Since banking is a cyclical industry, banks are also facing challenges during a severe recession. If large depositors default on loans, banks could come under pressure. However, there are safeguards in place, such as limiting banks' exposure to a single borrower. Additionally, the Federal Reserve has imposed capital requirements on banks to absorb any significant losses from defaults. So, what does the Federal Reserve do to mitigate the impact? Typically, when a bank fails, the FDIC intervenes to cover any losses and arranges for another institution to take over. Customers may not even notice a change until their bank suddenly adopts a new name. However, the FDIC itself can face a shortage of multiple banks failing simultaneously, as was the case during the last recession. This is because the fund that covers the deposits generated from insurance premiums paid by the banks is significantly less than the total number of deposits. The Fed has a reserve requirement mandating that banks keep 10% of deposits in reserves. These reserves also serve to protect deposits during a crisis. Recently, in March 2020, the Federal Reserve lifted the requirement as it implemented the most aggressive monetary policy easing in history. And you know, there is a connection between interest rates and economic downturn. Typically, the Federal Reserve reduces interest rates during an economic downturn to provide support to the economy. However, the current situation is different, and the Fed is actually raising rates. In an environment of declining interest rates, banks experience a decrease in their net interest margins, since they typically borrow for the short term and lend for the long term. However, in a recession with rising interest rates, banks would not benefit, as it would only exacerbate loan defaults. Rising interest rates would make loan repayment even more challenging for borrowers. Is your money secure in financial institutions during an economic downturn? Most individuals would recall the Lehman Brothers crisis of 2008. The majority of other US financial institutions were also severely impacted by the economic turmoil. Generally, money held in a bank account is secure even during an economic downturn. However, depending on factors such as your account balance and the type of account, your funds may not be entirely protected. For example, Silicon Valley Bank likely had billions of dollars in uninsured deposits at the time of its collapse. Fortunately, there are measures you can take to enhance the security of the funds you have in the bank. Many believe that cash is king during an economic recession, but that may not hold true for every investor. Cash is often referred to as the ruler of investors. For investors, cash is king during an economic downturn, summarizing the benefits of keeping liquid assets on hand when the economy takes a turn for the worse. However, relying too heavily on cash can hinder your ability to achieve your long-term goals. To illustrate, let's explore some advantages and disadvantages of holding cash during a recession. Cash provides liquidity. One of the biggest risks individuals face during an economic downturn is the possibility of losing their job or being unable to afford bills. With a substantial cash reserve, it becomes easier to navigate uncertainty with more confidence, knowing that you are financially prepared. So, be rest assured, in all likelihood, your money is secure in a bank, even during a recession. So let's breathe for now and enjoy the calm before the storm. Hit the like button and subscribe to our channel. Until next time.